John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hello, my name is John Ulzheimer. I am a consumer credit expert. I have almost 30 years of experience in the credit industry. I have worked for FICO, which is the company behind the FICO credit scoring system, and Equifax, which is one of the 3 recognized credit reporting agencies in the United States. The question that I'm going to address is, why is closing your credit card potentially bad for your credit scores? If you have read anything about, don't make these mistakes with your credit, then inevitably you have read an article or heard people speak about the reasons why closing a credit card can lower your credit scores, okay? So let's talk about that. So why would you close a credit card? Well, you may not use the card any longer. You may be, the customer service may not be good and you may not like the customer service any longer. You may not want the card because of an annual fee or the interest rate, or the rewards program isn't any good. And you just may want to just pare down some of the bills you're getting every single month. So there's a lot of reasons why you could potentially want to close a credit card. So I'm going to explain to you what happens on your credit report, which is really the important thing, because your credit scores are based entirely on information on your credit report. So really what's important is, what does closing a credit card do to your credit report that can cause your credit scores to go down? They're not always going to go down if you close a credit card, but it absolutely can happen, and I'm going to explain how. I'm actually going to start with number 2 on my list. Just get straight into it. The reason your credit score can go down if you close a credit card is because you're going to lose the value of the unused credit limit in the revolving utilization ratio. Some people call it the credit utilization ratio. It's not really what it's called, but that's fine. But so many people call it that, we'll be done with it. But actually it's called revolving utilization. It's the relationship between the balances on your credit cards and your credit limits. And if you close a credit card, let's say you close a credit card that has a $10,000 limit, well, you're going to lose the value of that limit in the ratio that is calculated by scoring systems. And it's basically, ratio is you add up all of your credit card balances on your credit report, then you add up all the credit limits on your credit cards that are on your credit report, and you divide the balances by the limits, and that equals a ratio. And that ratio is going to range between 0% and something up to 100%. Unless you're over maxed out, then it could be over 100%. You have other problems. So if you were to close a credit card that's got a $10,000 limit, you're going to lose that $10,000 limit in that ratio, and your revolving utilization is going to spike. It is a mathematical certainty. Unless you pay down your credit card balances by the same amount, your utilization ratio is going to go up. And that ratio is very important to your credit scores. Some people incorrectly suggest that the revolving utilization ratio is worth 30% of the points in your score. Incorrect, factually inaccurate. It is part of the category that is worth 30% of the points in your score. So if I was going to create a pie chart, it is in the category of metrics that's worth 30%, but it by itself is not worth 30%. There are multiple other things in this category that contribute to the 30%. So that was one myth that we just busted. So when you close a credit card, your revolving utilization can spike. That is the only reason why your score can go down after closing a credit card. There is no other reason. However, one of the other myths that for some reason it won't die, it just keeps on going, is that when you close a credit card that you lose the value of the age of the card in your credit score. So you hear people say things like, well, if you're gonna close your credit card, don't close your oldest card because it's gonna make your credit report look younger. Factually incorrect, wrong, negative, that is incorrect. As long as the account still remains on your credit report, which it will, because the credit reporting agencies maintain accounts that are open and accounts that are closed, as long as the account is still on your credit report, you're still going to get the value out of the age of the card, regardless of whether it's open or closed. And get this, it even continues to age even after it's been closed. And so let's say hypothetically that I close a 10-year-old American Express card today, and you watch this video in exactly 1 year, then by that time it's going to be an 11-year-old American Express card on my credit report. So you still get the value of the age of the card, whether it's open or closed, as long as it's on your credit report. So we have just busted myth number 2 in that respect. But trust me, you're going to find blogs and articles, some of them written by reputable sources, that indicate that when you close your credit cards, your credit report can look younger. That's incorrect. If you're going to close credit, first off, I'd like to talk you out of closing credit cards. If you're worried about them being used fraudulently, run them through the shredder. They don't physically exist any longer. The likelihood of them being abused is really, really low. And you can't use them because you don't have the card. So it kind of prevents you from going crazy and using the credit limit, irresponsibly. And if you ever want a card, just call the issuer and say, hey, can I get a replacement card? And they're going to send you one. So you can always continue to use it. So I'm going to try to talk you out of closing your card. But if you're absolutely committed to closing a card, fine, but I want you to think about the timing of doing so. Because we have already established that your credit score can go down when you close a credit card, do not do it just before you apply for something like a mortgage or an auto loan, because your credit score can go down and it can make that loan more expensive. And those are the types of loans where you really want the lowest interest rates possible because they're such large loans. So if you're gonna do it in the middle of what I call no man's land, credit no man's land, in the middle of some period of time where you know you're not gonna be applying for credit for any period of time. So that way you'll be able to do some sort of a triage on your credit report and you'll know what kind of impact closing the credit card had. It may have little to no impact, it may have significant impact, you just don't know until you actually do it. So don't do it 30 days before you apply for a loan, please, please don't do that. So if you have any other questions about these myths or the impact of closing your credit card, drop them in the comment section below and I'll do my best to get to them. Thank you for watching. Have a great rest of your day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.